Jerome Powell came out today and gave a stance that essentially the stock market said that is the indication of him indicating that they're going to lower interest rates. So, what does that mean specifically? All right. So, let's kind of go through this all together. So, if you look at this deal, he's essentially saying, hey, nonetheless, with the policy and restrictive territory, because they are in a restrictive policy, the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance. So, this is the closest he's been able to state that they're probably going to endorse a rate cut. So when that happened, here's what happened in the stock market. If you look at what happened in the stock market, they essentially went up. They blew up, right? The Dow went up by like 846 points. Now, what's most important is that you have to look at the 10-year treasury and what's going on. Because this is a pretty big move in like less than a day, right? So they went from like 4.34 to 4.26, almost down 10 basis points roughly. But what does this mean for your 30-year mortgage interest rates? And in case those of you that don't understand what happens, right, I'm going to talk about the relationship and then most importantly, share with you how to look at investment properties a little differently afterwards. So if you look at the 30-year mortgage interest rates versus 10-year yield, the 10-year treasury yield graph, right? The 30-year mortgage interest rate is affected by two factors. One is the interest rate on a 10-year treasury yield, which we just saw at 4.2 something, and the spread between the 10-year yield and the 30-year mortgage interest rates. Now, the spread and the interest rates are heavily affected by economic conditions, the labor market, but also the commentary is very important. Okay. So if Jerome Powell comes out and says, hey, we're probably going to be changing our stance. We're probably going to lower rates, right? At least insinuating or implying that thought. Then now all of a sudden, your bond traders, they move faster than the Federal Reserve because they move based on future expectation of interest rates. So when that happens, interest rates move by zero point 0.8 pound at zero point 0.8 points on the 10-year treasury yield, even though the Federal Reserve has not said they were going to lower interest rates, right? You see this relationship. It is not a direct causation where the 10-year yield drops when the Federal Reserve drops the interest rate. When there is indication that the 10-year treasury yield is dropping, that's when there's an indication that the Federal Reserve is going to lower rates, then the 10-year yield drops automatically before and way ahead of that meeting, which I think is the next one is in September. Now, if there are better trade deals that happen, right? Meaning you start seeing trade deals, less worries about tariffs going on. Now you're going to start seeing that spread narrow between the 10-year treasury yield and the 30-year mortgage interest rates. Now, right now, that spread is roughly around 4.31 to 6.61. So it's about a 2.3% spread. Now, historically, the spread between the 10-year yield and the 30-year mortgage interest rates has been about 2% to 1.5%. Now, in the last couple of years, it's gone as high as 3%. That's when we saw interest rates in the eights, right? That's when nearly everything kind of just froze over. Like everything just kind of completely paused. That's not good, right? But it's also gone as high as like high fives for the spread in the 1980s. That's when you saw interest rates like really, really high. So, all to kind of wrap it up, you have to pay attention to the commentary and what's happening in the market and pay attention to the 10-year treasury yield. Don't say, like, oh, I'll wait until they lower interest rates. No, that's not it. Because the bond market moves faster than the 10-year treasury, than the Federal Reserve. So you have to pay attention to what's happening to the 10-year treasury yield. That's what you pay attention to. Don't listen to the headline news. Follow this because this can affect your interest rates for your 30-year mortgage interest rates for your rental properties overnight. That can literally happen overnight. So just be very, very mindful of that. All right. So the next thing I'm going to cover with you is, well, what does this mean if you're analyzing a, let's say a rental property, right? So let's look at a market. Let's use a real live example. So Right now, I'm looking at Johnson County in Kansas. This is just outside of Kansas City. I'm looking at Kansas City right now because I know they're going to host the World Cup soon. I think it was 2026 or 2020, I forget. And every single time there's an investment in that area for worldwide sports, generally there's a lot of infrastructure that gets built. But I know that Johnson County is sort of like a nicer area in this specific place. Now, let's see. Ooh, Perry Village. Let's look at this one. So this property is let's see. I think I analyzed this property just the other day. What's this one? Overland Park, 175. Just pick one, huh? 159, 167. Huh. Can't see any photos. Let's see if I can find a good property here. Okay, I got some old photos right here. So good. This gives me a pretty good indication of what it looks like. Now, for me, in my opinion, this property is pretty close to being rent ready. Now, would I change the flooring instead of using carpet to LVP? Yeah, I would. But let's see if the numbers justify it, right? So, whenever I see a property like this, I have to figure out, okay, what am I going to analyze this property as? Two bed, one bath. So, there's two data points that I need to get right away for this property. The first thing is I need to look up the 2025 Johnson County Housing Authority payment standards. Let's see that app. Johnson County Housing Authority. Great. First link is right here. Johnson County 2025 payment standards. And they're going to give you the payment standards by zip code. For this property in 66208, let's look it up. 66208. You're going to see that the payment standard for 2 bedroom is 1825. Great. Let's go ahead and do this. 1825. 2 bed. Now the 3 bed HUD SAFMR is 2400. I like to have these numbers in place because guess what? If there's ever a property that's a 2 bedroom and there's opportunity for me to add an extra bedroom, that makes it a lot more valuable. That's important. So that's why I'm working on understanding what's happening in this market. So now that I got my payment standards, right? That's typically the rent ceiling. And if you don't provide utilities with your rent, typically you have to back out your utility allowances for that property. So you can see right here, this is a great housing authority. They have like all these things listed out. So if you have a 2025 utility allowances payment standards, and let's say you for a 2 bedroom, you're in a condo and you don't cover natural gas or heating, then you had to deduct $27 from your payment standard as your maximum rent. So that's the first thing you got to learn. The second thing you got to understand is, well, what is my market rent? And if you go to affordablehousing.com and you go to the owner section and you go to the market rent estimator, you plug in the address 5137 West 75th Street here, plug in a bedroom count, you're going to see that the average rent in Prairie Village here is going to be 1522. Now, the crazy part is you might have thought you could rent it out for 1825 because that was your payment standard. And some Section 8 gurus out there will say, oh yeah, you take your HUD FMR, you deduct your PITI, and that's your cash flow. That's so far from the truth because they haven't even taught you about the rent reasonableness test. And you might think about like, hey, what is the rent reasonableness test? Look at this. Let's see, rent reasonableness test. Rent reasonableness. They have a section right here on rent reasonableness. Let's go here. Housing authority for landlords. And if you click on rent reasonableness, this essentially tells you that Johnson County Housing Authority must ensure that the rents charged by owner landlords are reasonable. And they compare the proposed rent for your unit, that's rental section 8, for similar non-subsidized units. This means that you can't charge more to someone simply because they are a voucher holder, right? For the obvious reasons. So that rent reasonableness test means that you have to analyze this deal at 1522 because that's what the market says is reasonable. That's the market rent. Now, unless you have better information that in your area, the housing authority always pays you more, maybe because you have better rehab, property, etc. Yeah, you could probably stretch it to like 1600, 1700. But I personally, I wouldn't underwrite like that. I like to be a little bit more conservative. But again, this is not investment advice. I'm not soliciting any investments on this call. Just simply showing you how to adjust the lever so you can learn how to do it on your own. All right. So let's keep on going. So for this property, again, if you guys want to copy the spreadsheet, just go to affordablehousing.io, not .com. Go to the Get a Deal Analysis tool. That's the fastest way for you to get a copy of the spreadsheet and follow along. Because my goal is this, I hope you copy my homework today and you analyze the same deal I'm analyzing today. Because guess what? Over the course of time, when you build your own YouTube channel, you can achieve the same level of recognition, right? If you ask ChatGPT right now, what is the best podcast on affordable housing investments and who is it hosted by, you're going to get this podcast right here, this YouTube channel, because of all the consistency that we've been going through, analyzing deals every single day. Because at some point, someone's going to ask you, hey, why do you think this is a deal? And you can say, hey, I know this is a deal because I've been looking at deals for the past 694 days in a row, right? Might that give you some confidence that you know what you're doing? I certainly hope so. And I know sometimes the first step is so hard, but you can do this. The first step is so hard. That's why I'm just saying, just copy my homework. That's it. All right. So let's plug in some numbers. $167,000 in B4, which is my asking price right here. Now, for my renovations, I am going to go through my spreadsheet. Now, typically, I always, for single family home, I would set aside money for a roof repair, etc. But in this scenario, it's an HOA, it's a condo. So I'm paying a condo fee. So that's why I won't be responsible for any of the roof repairs. Okay. Now, painting. This property is 950 square feet. I'm assuming it looked, I mean, the pictures looked pretty good earlier. So I'm going to assume I only need to paint like a third of the home, if even, at $3 a square foot. I'm going to assume I need to replace some of the carpet, about 300 square feet at $8 a square foot. For flooring, great, easy enough. For me, I always like to replace one of the toilets with a high pressure flush toilet. That will probably cost me about 600 bucks now with labor and everything. Now that I just checked on toilet prices recently. So I get the pressure flush toilets because I never want to get a clogged toilet call. I have these pressure assisted flush toilets at my Airbnbs. And guess what? I've never had a clogged toilet call before. So I'm going to keep it that way because people underestimate how much time, how much energy it takes when you have little problems that just drains your energy, it takes you away, and makes you not want to keep doing it. So just solve some of these problems up front. All right. Now, for this property, I don't think I need a cage on my HVAC, but hey, I'm gonna put it in here just in case because I want to be conservative here. I've had a HVAC unit stolen before. It'll cost you 6 grand. So for me, I'd rather just spend the 900 bucks, put in a cage, and prevent any more issues. All right. So that gives me a total rehab of $5,760 with a little bit of contingency. For my taxes and my insurance, let me get that from my payment calculator right here. So for my taxes right here in the payment calculator in Redfin, again, you should verify with your county assessor records, but I can use this as a general rule of thumb. For my home insurance, it equals 109. So I'll do equals 109 times 1.2. I'm multiplying this by 1.2 because I'm assuming there is a 20% premium because typically insurance companies view investment properties as a riskier asset versus a primary residence property, right? Because typically tenants might not take as good care of a home as if they own it and lived in it. Right. That's just a general perspective that they have. So that's why I add a little bit extra. Now, for my maintenance, typically for single family homes, I have 10%. But in this case, because I'm paying such a high HOA fee of 316, which I'll put into B34, I know that the HOA fee is going to cover things like landscaping, maintenance, exterior maintenance, some common area plumbing, the roof, right? I'm putting aside extra money. But it should not be zero. Because guess what? Oh my goodness. Like there are some gurus out there that I've literally seen it on the Instagram stories where people are asked, hey, how much do you set aside for maintenance? And they said none. We buy turnkey properties. And that is so irresponsible. It blows my mind because Guess what? If you're a long-term buy and hold investor, you definitely expect, know for a fact that something's going to break in your house and you're going to fix something. So don't underestimate your expenses and overestimate your profitability because you're lying to yourself. Don't do that. Always have something here. It's definitely not zero. So I set aside 10% for property management expenses here. And some people will actually not underwrite with property management expenses in there. So that's why they have a much higher cash to cash return. My argument is, yeah, it's great if you want to self manage, perfect. But I think most of us got into it for passive income because if you don't underwrite with with property management in places and it still meets your criteria, then guess what? You bought yourself a job because then you will never have enough margin to offload the property management to if you were depending on that income, that monthly cash flow for your living expenses. It doesn't make any sense. Now, next thing is the vacancy, right? You know that someone's going to move out of your home at some point. I mean, the goal and hopefully is that they stay for 5, 10, 15, 25 years. Again, this is why I hope this property does well because in Prairie Village, your schools are like 7 or 8 out of 10s, right? These are great schools. So typically, I mean, if I was a single mom, I'm trying to live somewhere, I would want my kids going to school there. And that's a hidden jackpot for my kid because I know that they're going to be okay for the next 15, 18 years because they're going to a good school. So something for you to think about. Better schools, probably lower vacancy. Not as nice areas, you might have higher vacancy, to be honest with you. All right, so let's keep on going. So for my down payment in F19, my down payment monthly on equals to B4, which is my asking price, multiplied by my down payment percentage. So that gives me $41,750. I got 3.5% for closing costs here. I got $57.60 for my renovations. So this is where everything ties together. All right. Now, probably last week, I just refinanced a property about less than a month ago for 7.875% interest rate on a DSCR loan, which means that it was a 75% loan to value product. So I would have to have 25% equity, but then the lender will cover another 75% in the form of debt. But the interest rate I got was 7.875%. So in this scenario, right, if you rent this property out as a 2-bedroom and you only got it for 1522 for rent a month, you would be losing $271 on this deal. Your cash on cash return number is negative 6.1%, assuming you bought this property for $167,000 with a, just rounding here, $5,800 rehab, 25% down, and a 7.875% interest rate. Okay, great. Now, let's put it all together. Let's talk about interest rates right away. Let's say I need to make 8% cash and cash return. What do I need to buy this property for? So I need to lower my asking price in B4 to achieve an 8% return in E9. Let's go to 100 grand. Let's go to 90 grand. Let's go to 80 grand. Okay, so maybe 85, 83, 82. Great. So I will have to buy this property, assuming everything stays constant, right? I can rent out for 1522 because now I can cash flow $191 a month. And the big HOA fee is probably the driving factor here because now I can make 7.9% cash and cash return, which rounds up to 8%, right? And again, I had to buy this property for 82 grand when it was listed for 167. Is that reasonable? I mean, probably not, but at least now you know. But what if, like we talked about, Jerome Powell comes out and says, hey, we're probably going to shift our policy. We're going to be less restrictive. And now your 10-year yield drops by 0.1%. I mean, maybe it drops by another 0.25% in over next week. Boom. Now, all of a sudden, it drops a whole point, right? Because the spread narrows with better news about the trade, the tariff war, blah, 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 with Jerome Powell saying that he's going to lower interest rates, or even someone like Trump appointing someone to say, hey, this person is going to be the next Fed chair. And that Fed chair goes around to the bond traders and says, hey, as soon as I get into office or become the Fed chair next year, I'm low interest rates like that right away. That can drive a full point move overnight. And look what happened. When your interest rate dropped by a full point in K7, your cash and cash return number jumped up to 9.6%, which means in B4, your asking price now can go up to, let's say, 89. Boom, that rounds up still. So your interest rate dropping by one whole point, assuming Arizona stays constant, right? Same rent at 1522, because now your cash flow is $198 a month. You are cash and cash return 7.7%, but you're now willing to pay $7,000 more for that same property to achieve the same target return of 8%. Now, again, I'm not saying 8% is a magical number, right? Some people will buy single family homes in California for like $1 million, and they don't care. They're like, hey, if I make 5% appreciation every single year, that's like $50,000. Like, who cares about $100 of cash flow a month? I'm making 50 grand a year on appreciation. Right? Complete different strategy. It's more speculative, but who's to say you can't have both, right? Again, that's your own strategy. It's your own preference. It's you got to figure out what's the right move and target for your portfolio because you know your own situation best and your own risk tolerance. And that's why I go through this, right? That's why I go through this. You have to figure out why you're doing this and how to adjust the interest rates and how to adjust the factors. Because guess what? Maybe you start inspecting the property and in B6 here, I'm going to triple the rehab, multiply by 3 right here. Because you found out the plumbing's all out of whack and you had to replumb the entire unit. Well, if that happens and triples, guess what? Your cash and cash return just took a dump. I mean, now you might be at 72 grand, 75, 78. Great, that works. So because your rehab tripled to $17,000 almost, you now can only pay 78 grand. So now you don't get emotional, right? You don't get all freaked out. You're like, oh, what am I gonna do? Just go to the seller here and say, hey, look, my rehab just tripled. I need an 11 grand rehab. I know the offer I gave you previously was for 89,000, right? Assuming 6.875% interest rate. So like the interest rate dropped the full point already. But now you see how it all works, how it flows together. This is how you take emotions out of the deal and figure out whether or not this works for you. And you stay objective based on the numbers of what's going on. This is how you do it. This is how you learn. So I'm so grateful for you all listening today. Hopefully, you guys learned something. And more importantly, you're able to tie what Jerome Powell is doing to how it affects the interest rates right here that I did in K7 that ultimately affects how much you're willing to pay for a property in B4. And accordingly, if your rehab numbers change, you just adjust these numbers and then you get back to your own tiger criteria because you got to figure out, hey, why am I doing this? If I'm only getting a 4% return, why don't I just buy a 10-year treasury yield? Why am I going through all the stress, all this headache for 4% return? Well, maybe there's appreciation. I don't know. It's completely up to you. You got to figure it out. But again, I hope this was helpful for everybody. Learn and watch the 10-year yield. Don't focus on the news on when the Federal Reserve is lowering interest rates. Focus instead on a 10-year yield where it's moving up and down because bond traders move way faster than the Federal Reserve. And based off of that, adjust your numbers accordingly. Follow and stay on top of what's happening to the 30-year mortgage interest rates every single day as it fluctuates. Because like you saw today, when that interest rate dropped a whole point, my buying power just went up by $7,000. That happens every single day. Again, I hope you copy my homework, right? I hope you analyze the same deal I analyzed today using the same spreadsheet and start your own YouTube channel. Because I cannot emphasize how important it is for you to believe in yourself, but also for other people to believe in you. then you know what you're doing, even if you're new. Because that's how I felt when I first started. I didn't know who to ask, I didn't know who to go to. But that's why I started Affordable Housing Podcast, so I can bring on contractors from different markets, property managers from different markets, so that at least you know who the first person you might call in that market. And then that makes the next two steps way easier. Sometimes that first step can be a little mysterious, but if I can show you the contractor you can call for Kansas City and show you how to analyze a deal, just copy my homework again for the first time in that city, then now all of a sudden you feel more prepared, you feel more brave. All right. If you all could do me a big favor, please leave a review for our affordable housing real estate investing podcast on Apple or Spotify. I've had some haters just because it's affordable housing. They I don't know why people just have negativity towards it, but it's just hardworking people, just like my mom, who are trying to put food on the table. So I would really appreciate it if I can use some positivity from all of you to leave a 5-star review on Apple or Spotify. It will help so much for me to get the word out there. Thank you so much for caring about affordable housing. Without people like you, I would never have the home I grew up in. I appreciate it so much. Thanks for tuning in to Lives. I know it's Friday, it's late on a Friday night, but hey, we're analyzing deals together. We're learning how to get better. Thank you. Have a good night, everybody. I hope you spend some quality time with your family and friends today because that's what life is all about. Have a good one.